Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. On the episode today, as part of our pre-budget series of 10 years of Modinomics, we pick up the topic of the shape of India's recovery post-COVID and in the future. And joining me to discuss that is Upasana Chachra, the Chief India Economist at Morgan Stanley, and Rumki Majumdar, the Economist at Deloitte India. Welcome to both of you and viewers. We have two very fine minds in the space of macroeconomic research who are here with us. I want to start by taking up that point about what, Upasana, is your view as far as the future trajectory of growth is concerned, and when you answer that, also give us your sense of how we have done in the past 10 years. Is the cup half full or half empty in your view?
Thanks, Siddharth. So in our view, the growth trajectory, and when we think about our year ahead outlooks, we term it as steady expansion. So we've seen that the economy has, the outlook or the growth trend has improved post the pandemic. There have been some, unevenness in this growth trend as we see that the rural economy has been a bit more sluggish while urban incomes have done better, capex has done better, and but we do think that these anomalies will drift away as we go further into the expansion. So in our view, growth trend will be more steady and more sustainable in the future. So in our view, growth will be around 6.5% for fiscal 25 and thereafter. And more importantly, in our view, this growth will be more broad-based with a pickup in capex to GDP and also consumption doing fairly well. I think, as you asked, what has been the trend in the last 10 years? And I think if we all think about how the economy was in the previous 10 years or up until the pandemic, the growth trend was lackluster, especially if we think about the environment in which private businesses were operating, or if we look at the metrics such as investment to GDP, which saw a steady decline, or corporate profits to GDP, which again saw a steady decline. I think all that is set to reverse, and we are already seeing some incipient signs of it. So the key will be steady growth, but also more sustainable growth in the future.
Steady and sustainable growth, Rumki, that's the way Upasana has described it. Add to that, and also what would drive future growth, the steady and sort of sustainable growth that Upasana speaks about?
So I agree with Upasana, and I'm extremely confident that the growth we are seeing is here to stay. And I would say, as you asked, glass half full, and it's going to get fuller going forward. A bit of a context before I say what are going to be the drivers. See, over the past 3 years, it has been very tough for the Indian economy, and we faced the pandemic. We saw a surging inflation in the West, followed by a very steep hike of monetary policy rates by central banks, and of course, not to mention the geopolitical tensions. This year, also 2024 will likely be a modest growth globally. And more importantly, we will see about 64 countries heading to polls, which will lead to political uncertainties as well. Now, what we have seen is India has remained resilient. After the pandemic rebound, it's not only grown stronger in the last 2 quarters, we have averaged 7.7% growth. And this is because of the fact that India has sailed through these uncertainties while building the ship, I would say. Now, 10 years back, we were given a status of fragile five, if you remember when Fed taper tantrum happened. And from there on, today we are the first five nations in terms of GDP. Consider any parameter, be it the current account deficit, be it the reserves, the infrastructure spending, the banks and corporates balance sheets, tax revenues. We have improved pretty much on all parameters, and that rebound is because of the fact that the government has done steady reforms and brought in steady initiatives over the years. Now, what are the drivers going forward? I would say that the initiatives that the government has taken towards allocating funds in infrastructure, that will continue, and the government will be cautiously looking at how the private capex is coming in, and then decide how they want to take it forward. But critical infrastructure is needed in India, and that momentum will continue. Second would be the emphasis on technology. Now, over the last few years, we have seen technologies like UPI, account aggregators, online e-filing, FASTag. All these are initiatives by the government, and they have increased the efficiency of the country as well as inclusion. And all these will be emphasized going forward as well. And the third emphasis will be on the high-end manufacturing capabilities. We all know that services contribution to GDP has been very high, and while over the years manufacturing sector's contribution has remained more or less stagnant. So the government has realized that our dependence on imports for critical manufactured good is high, and that's why the government has taken initiatives like the PLI schemes, the reduction of tax. All these will help improve the growth going forward.
Okay, three key points. Upasana, I come to you. Every budget is looked at least not just for some of the numbers, but more importantly for the directional signals that it provides in terms of the government's spending priorities, as well as what is likely going to be the impact. This is just an interim budget, but I think it's being watched very closely given the past experience in 2019 with the announcement of a few new schemes. And remember, viewers, with the budget now coming on the 1st of February, it escapes the model code of conduct that is always an issue if it were to be 28th February in a election year. So given that backdrop, what are you looking forward to as far as the broader growth impetus is concerned from this interim budget, which hopefully will be a continuation of what will come in July? Upasana, that question was for you.
Yes. I think you made a very important point, Siddharth, that, while it's an interim budget, we've seen what the government did in 2019, and it was, far from the usual interim budgets that we would have seen in the past. It was a pretty detailed statement with a lot of some new schemes also getting announced. If we recall, PM Kisan was announced in the 2019 interim budget. The government also increased the standard deduction for income taxpayers, and there were also certain measures on the housing aspect related to rent. So I think with that backdrop, I think the government will be pretty serious about this interim budget as well. So it's not probably going to be as mundane, and they will try to utilize it as an important platform. But having said that, I think the key, as I mentioned, is probably just sustaining this growth momentum. So from a policymaker's perspective as well, I think the budget should probably continue on the policy efforts that it has laid out in the last 3 years, and with the change that the government has tried to do in terms of focusing more on manufacturing, focusing more on infrastructure investments, and spending more on capex on through their own accounts, and improving the expenditure mix. So I would be looking at the expenditure mix again. We do think that the government will continue its momentum on public capex spending. So public capex spending continues to go above nominal GDP, and therefore, capex to GDP, that ratio continues to go higher. That's we are building in. At the same time, on the revenue spending side, I think there is scope for rationalization because it's still tracking higher than the pre-pandemic averages, and with some rationalization over there possible, the government will still be able to adhere to its medium-term fiscal consolidation path, given there is also support coming from revenues, like we are seeing upside surprise in tax revenues, especially in this as well. So all in all, I would say that this should be more of a continuity in the policies that we are looking at, especially from a focus on infrastructure spending and capex spending from the government. And at the same time, probably on the revenue side, the focus on rural economy, as it has been in the past few budgets, will continue. So, I think probably the focus areas from the government side would be more capex and support to rural incomes, and at the same time probably some support to the salaried income tax payers, as we saw in the past.
Well, the last bit is definitely an expectation. We don't know what will happen. 2019 was a good surprise. But Rumki, I'm coming to you. If Bharat has to be addressed more, that's the point that Upasana makes from a budgetary spending priority perspective. Does it mean, therefore, that the government perhaps needs to step back when it comes to driving some of the capex-led infrastructure growth, creating one space for the private sector from a cost of money basis, and also to ultimately realize that it has to take care of social priorities while the private sector has to go in and do some of the heavy lifting? Is that kind of recalibration possible this year, if not on 1st February, but perhaps in July?
It is quite possible, and as I mentioned earlier, that all eyes are on India is how the government is deciding its allocation across different sectors. Now, the government has been very prudent about its spending, and it is spent on sectors where the fiscal multipliers have been very high. And that's why the allocation towards the capex, towards infrastructure, which has a multiplier of 2.5%, was vis-a-vis spending on subsidies and pensions, which have multipliers of less than immunity. So, but the government will also decide based on what evidence it is getting from, or what cues it is getting from the private side. Because if private capex is picking up, then the government will obviously recalibrate its spending. But on the other hand, if it takes a while to come back, then the government will probably keep pushing the pedal.
What's your own reading of private capex?
So the private capex, we believe, is picking up. In fact, over the last few quarters, you see the gross capital formation has been the biggest pillars to growth. And we going forward, as we expect the US Fed and the ECB might cut policy rates, which will ease the liquidity conditions globally, that might even give more incentives for the global investors to bring in money, and we'll see capital inflow. So I believe with second half of 24, there will be a good momentum in private capex as well.
Upasana, the government has made very deliberate economic choices, and I just refer to one, for example, in Air India, where potentially it saved itself from annual equity infusions to keep the airline afloat and took a one-time hit. Do you expect the government of India, the central government, and we are not talking about the states at this stage, to continue to be the big driver of our growth over the next 5 years, and assuming what the markets seem to be building in, another third term for Prime Minister Modi?
So, I think if we take a step back and see how this growth trajectory has panned out and what has been, the key factor that the government had to take this sort of counter-cyclical fiscal expansion or support to growth, and it was because of one was the economy was slowing as we entered 2019 or through 2019, and as we entered the pandemic, and thereafter the pandemic was a big shock to the overall system, both the supply and the demand side. And coming out of it, the government and policymakers rightly sought the approach of supporting growth, and also took the difficult decision, I would say, of taking of supporting growth through capex rather than spending money on subsidies or handouts, which are easier to do in a way. But they took the difficult decision of spending money on the capex side through infrastructure investments, coming out with plans of national infrastructure pipeline, and basically putting that whole thing out, that this is what they want to do in terms of building the infrastructure at a large scale, and the amount of support that the public sector is going to give. So in that context, I think now if we see going forward, and as you were asking earlier regarding the question of private capex, I think eventually over the next 5 years, the role of the government in supporting growth should definitely come down as the private sector comes back and the animal spirits are reinvigorated fully. As we just discussed earlier, there are nascent signs of recovery in private capex. It's not really broad based at the moment, but we will get there, as end demand is improving, as manufacturing capacity utilizations improve further. They are already tracking better than what we saw pre-pandemic. That, and as funding conditions are, largely better than where we have seen in the pre-pandemic time. So with that type of backdrop, I think private capex will definitely come back. And as that happens, as Rumki was also saying, that's when the recalibration can happen automatically. So the role of the government in supporting growth will gradually recede, and that of the private sector and especially private capex will gradually improve. And that's what I think we definitely need for the growth cycle to be sustained as well, because recall India's public deficit and India's fiscal deficit are definitely elevated. So there is not that much scope that the public sector can keep doing in terms of providing that incremental delta to growth. It can sustain the growth, continue to grow at nominal GDP, but the kicker that you keep getting, that capex to GDP is now at an 18-year high at 3.2% and 3.4%. You can't keep getting that at that same pace going, in all years to come. So I think in the near term, probably public capex will continue to grow above nominal GDP just because of the whole infrastructure investments that are there. Those are like work in progress. You can't really roll that back. But as private sector capex improves, you will see that shift happening, and a healthy shift, I would say.
Rumki, I'm following up on Upasana's point with the question that do you think all the conditions have been created and exist now for a takeoff in private sector spending and large investment plans? If you take out some of the larger groups and certain ambitious investments in new energy, for example, just as one area, most of the large investment plans seem to be behind us, including telecom, which saw one of the largest ever investments by the Reliance Group. So, are you confident that the private sector will step in, or will the next 5 years also see a majority dependence on government doing most of the heavy lifting? Rumki, you have to unmute yourself. We can't hear you.
Sorry.
Yeah, go ahead.
As I mentioned earlier as well, that private investors are probably looking for cues, and what they are looking for is how the global conditions pans out. Now, the fact that global uncertainties are here to stay, and this is something which the private investors have probably factored in. What There might be some delays in spending this year because, as I said, this geopolitical risks keep escalating with something or the other coming up with the crisis that we are seeing at Red Sea. Also, a lot of countries, major countries like US, UK, Germany, they are all heading to the polls. So there will be uncertainties on that from that angle as well. But what I believe is once these uncertainties reduce, if the Fed also decides to cut policy rates by the end of this year, there will be a boost in confidence and there will be capital flows. Private investors also will probably see money flowing in, and of course, our capacity utilization is already high in the country, so we need to build the capacity as well. And there are new emerging areas such as the green energy, investments in renewables, investment in some of the sunrise sectors like defense, in semiconductors. All these are picking up. So there are opportunities which are building up, and I think the private investors will grab onto such opportunities the moment things start looking better.
Okay. Upasana, there's also been a debate around the shape of India's recovery post COVID. And 2024, what's your own sense of the kind of recovery we will see? Because at the sectoral level, you could argue there is a K shape, but at the aggregate level, many people believe that it is not a K shape. It's been a V shaped recovery. What's your own take on that?
I'll probably agree more with the latter, that if you look at if you look at GDP growth, it's a V-shaped recovery. But if you look at the components, so if you look at consumption, investment exports were the key drivers of growth in the initial stages of recovery post the pandemic. So both capex and exports, and rather exports and then capex, saw a V-shaped recovery in that order. And it's consumer which has seen a more prolonged recovery. So I'll not really say it's K-shaped, but it's just that the consumer sentiment and the consumer recovery has been more sluggish and has been slower as compared to the recovery that we saw with capex and investments. Um, Consumption recovery, I think, has been slower because the impact of the pandemic on the consumer balance sheets has been much more severe. We do know the impact that it had, faces the impact on livelihoods and the jobs lost. And at the same time, as we were discussing, the fiscal support has been more on the supply side, or on capex, or to the consumers, was more in the form of supporting the vulnerable in the form of support in kind, like free food programs. So there wasn't like the best style support of giving money, or these allowances, and they actually then sat on excess savings. So India had a different approach to that, and therefore I think the healing of consumer balance sheets, especially at the low income levels, have taken time and have been longer than expected. At the same time, at the low income level, we've had the other issues that happened post the pandemic. So while livelihoods have got restored, and as we can see it from the unemployment related data, largely back to pre-pandemic levels, we had the issue of the high inflation in 2022, which does impact the low income or the terms of trade of rural economy more adversely. And at the same time, last year in terms of weather was not the best of situation, with a subpar monsoon, which again impacted agriculture output and also the farmer incomes, or for the farmer as side of the rural economy equation. So I think I wouldn't go with the adage that it's a K-shaped recovery, but rather I think just that the consumer has seen a more prolonged recovery. But I think things are on the mend. Some of the high frequency data points for rural do show that things are improving. If we look at AC Nielsen's volume growth in the FMCG space, so rural volume growth is picking up. It is lagging urban, but it's not that it is continuing to remain in contractionary territory. So in the last 2 to 3 quarters, it has turned positive. Two-wheeler sales are picking up. So I think overall the trend is of an of improvement, and that should help in bridging this gap between, say, the urban and rural demand that we've seen in the economy.
Uh, Rumki, Upasana touched upon inflation, and I want you to take that forward. When we discuss growth, when we discuss government spending priorities and private sector, for the broader masses, inflation is clearly a very important issue, and it bites the poorest the most. What's your own sense about the kind of inflation trajectory we are likely to see in the short to medium term? Because projecting beyond that, I think, is a tough task. So I'm going to ask you to take your best shot at this question.
So, if you look the inflation trend over the last few months, the core inflation has actually been declining. And there's a study by RBI which said that till March 2023, 55% of the inflation was because of supply side shocks. And even right after that, you would see core inflation has been declining. And even in the last 2 months, when inflation went up, we noticed that the inflation was high because of the food inflation, while core was below the Fed's target rate. So clearly, there is a scope, there is an expectation that the inflation is probably coming down, except for the food prices, and that's what the government would probably double down on making efforts that the food price does not translate into broad-based inflation going forward. Uh, my expectation is over the next 6 months, inflation may remain high and then come down sustainably unless there are any supply side shocks from global exigencies that we are looking at. Uh, um, yeah, that's about.
Okay, Upasana, you concur with that view that after 6 months we will see a decline?
So actually, I think inflation trajectory is looking a little better than what we were expecting for probably 2 to 3 months back. So when we look at our numbers and our forecasts, we are tracking inflation at 5 to 5.2% in the first half of calendar year 24. So more around that, say close to 5% more or less in the first half. The second half actually can be even better, especially in 3Q, because you have a large base effect from last year. Recall, tomato prices went up and inflation went up above 7 in July, sort of remained at that 6% level in August as well. So you can see inflation numbers actually say 4 or maybe below 4 in that 3Q, driven by the base effect. But as a whole, as of now, inflation trajectory is actually looking a little better because, as Rumki mentioned, core inflation has been moderating. We are at multi-month lows in terms of core inflation, tracking at 3.9% in the latest reading. The drivers of core are coming more from like core goods numbers moderating. So, core goods was another factor which led to an upside surprise in inflation in the earlier in 2022 inflation phase because of all the supply side disruptions. And that happened across economies. So now that's deflating. Core goods prices across economies are deflating, and that's contributing to core inflation moderating. And at the same time, core services inflation has been steady to a little weak. So that's sort of a good mix to have in terms of core inflation. It doesn't look like it should go back up again very quickly because some of it is also normalization, like core goods coming down. So core is okay. I think the key is about food inflation. At least for now, the food inflation risks look lesser because high frequency data for vegetable prices has deflated quite quickly. So I'll also add that I think all these food price shocks, especially on the vegetable price side, are now becoming less intense and less prolonged. So they tend to deflate as quickly as well, which is good news because that means that the inflation, the impact on inflation or the unanchoring of inflation expectations is less of a risk in this scenario. So food inflation outlook is looking better. Rabi crop or winter crop sowing has lagged a little, especially for pulses. So there will be a little bit of concern around pulses inflation in the near term. But I think overall, if we think about food inflation, it's not looking very, very bad as of now. We will probably again look out for what monsoon forecasts we get, and then the next cropping cycle and how that turns out. But I think till then, it looks like we are looking at an inflation trajectory which is closer to 5% in the first half, which is not a bad outcome versus where we were in the second half of last year, where inflation has averaged almost close to 6%. So I think from an inflation perspective, things are looking better. But of course, we've seen from the recent past that these supply side shocks have become much more frequent, and therefore you need to keep an eye out on that. And I would say that while at the moment food inflation is looking well behaved, we can't ignore it because of the uncertainty around weather and the fact that it adds about 40, it contributes 40% to India's CPI basket.
That's a detailed point that you make, and in fact, viewers, just last week I was able to talk to RBI Governor Shaktikanta Das at Davos at the World Economic Forum, and he answered the question on inflation and what he sees likely in detail during that. As we wind down the conversation, I'm going to come to both of you, and Rumki, to you first on what is that one or couple of big numbers or data points that you are looking forward to from the budget on the 1st of February?
So on the 1st of February, I think one of the emphasis would be on social spending. So spending on health and education will be a priority because government realizes that human capital is where our competitive advantage lies, and with changing technology, the government would try to ensure that our human capital is prepared to what comes in what is coming ahead of us. And secondly, health is very important. Healthy citizens can actually contribute a lot to the country, and that's something which we have seen the government allocating higher in the past budget as well, higher resources towards these two in the past budget, and will continue doing so. Now, that would be one of the priorities I would suggest. Second, I think the government would be emphasizing on transition to green growth, because over the last few years, we have realized that our import dependency is very high on fossil, as we import large amount of fossil fuel energy from abroad. And we need to have that energy self-sufficiency and energy security. And India is also committed to net zero target and has a few intermediary milestones to achieve. So India will double down on its effort to install non-fossil fuel capacity. And given the fact that technology and cost of solar and wind panels are coming down, this will probably help the government to make quick reforms in the sector.
Okay, Upasana, what are you looking forward to?
So I think, from a macroeconomic standpoint, a few things that probably would matter from our perspective is, one is the fiscal consolidation path. We are tracking definitely above where we were pre-pandemic. We have adhered to a gradual fiscal consolidation path, but I think if the government is serious about reaching 4.5% by fiscal 26, it means they need to do a little bit higher in terms of consolidation over the next 2 years versus the last 2 years. So we are looking at a number close to 5.2% of GDP for fiscal deficit to be set for fiscal 25. So, basically evenly spreading out the consolidation that's needed, and then you reach 4.5 for next year. So that's one number that we will be focused on. Second is the credibility of achieving this number in terms of tax revenue growth assumptions, expenditure growth assumptions. In the last few budgets, we've seen that the government has been very prudent. So I think probably we will not have any major surprises on that front, and we'll get to see a realistic fiscal math around the fiscal deficit number. Apart from that, we'll be looking at the capital expenditure number, because as I mentioned, that's a key thing that we think should continue in terms of policy support for public capex spending and infrastructure spending. We do think that the capex spending growth would moderate from the last 2 years. It's been growing around 25 to 30%. So we are taking it lower, but still above nominal GDP to balance it out with the fiscal consolidation path as well. So we think that number could be close to 17 to 18% YOY. So still pretty relatively healthy. And the last would be, the continuing with the theme of as Rumki also mentioned about social spending, so I'll just put it as probably easing the living conditions of common people. We've seen that budget or outside of the budget, the government has done a lot of measures, be it financial inclusion or providing basic amenities like cooking gas or drinking water, tap drinking water, etc., or housing. So I think that whole set of measures is something that will come through in some form or fashion in terms of improving the living conditions for the common people. I think having said all of that, we've learned from the 2019 interim budget. They can utilize this platform in a way that we may not be able to predict right now. So I think
absolutely. I couldn't agree with you more, Upasana, because I was about to say that with Prime Minister Modi and his government, you can always expect the unexpected, because no occasion will be missed to put out a message, and more importantly continue to drive the priorities of the government. And as Rumki said at the top of the show, from a fragile 5 to the first 5, that in some ways defines the journey of Modinomics over the past 10 years. And the question is not just the 1st of February and the interim budget announcement, but beyond that, what happens in the broader political economy, and July, when the full budget will be presented. And as everyone seems to expect, including stock markets, it is going to be a third term for Modinomics, and perhaps some of the basis for that will be spelt out in the interim budget. Upasana and Rumki, thank you very much for your time with us today. With that, it's a wrap on this episode of 10 Years of Modinomics. We'll be back with more. Until then, goodbye.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
Once a unicorn that was ranked amongst the most valuable startups